Hello, my name is Monika Hengesbach. I'm an enrolled agent, an NTPI Fellow, and CEO of Decision Financial Services, and I'd like to welcome you to this episode of The Wealthy Wallet. Today, what I want to talk about are some of the tax stuff that everyone is hearing in the news today, and give you a little bit more of some information in regards to that, because I know the news reports are pretty much on a very high level. And so you have all heard of the tax provisions set to sundown. And this is something that is rather big. This is Trump's tax plan that was established back in 2017. And he had it set that on January 1st, 2026, these tax provisions were going to be set to sundown, meaning they're going to go away. So some of the comfort stuff that we have been able to enjoy are set to leave us. For example, the lower tax rates. He eliminated the highest tax rate bracket of 39.6%. Unfortunately, that is due to come back beginning January 1st, 2026. We have standard deductions that practically doubled. So, for example, it used to be $7,500 for a single individual. It then doubled to $14,000, then $14,500, $15,000. A married couple was $24,000 instead of $12,000. That is all set to revert back to what it once was before. We had itemized deductions were somewhat lowered because the standard deduction was higher. So, for example, we've all heard of the word SALT, that sales tax and local tax was capped at $10,000. So for people that are in either a high tax state or a high property tax state, they would be paying more in their taxes, but they would have it capped at $10,000. Itemized deductions, our mortgage interest, that was capped at $750,000. It used to be $1 million, meaning we were able to write off mortgage interest up to $1 million of our mortgage debt, but then it got capped to $750,000. That is all reverting back in 2026. So that means there's no cap on the SALT. So if you have property taxes at $15,000, you'll be able to write off $15,000. If you have mortgage debt over $750,000 up to $1 million, you're now going to be able to write that off. Unreimbursed employee business expenses went away. Those expenses are anything as a W-2 employee you're paying. For example, using your own personal vehicle, taking your clients out for meals, maybe having parties to attract new business. That had all gone away too with the 2017 Tax Act. That is set to expire, which means all of those deductions are set to come back in 2026. There's some other information like the child tax credit, was once $1,000. It got bumped up to $2,000. Well, that's reverting back to $1,000 in 2026. The alternative minimum tax was lowered. That's going to expire and revert back to pre-Tax Act days. One of the things that I think is going to be really detrimental if they allow all of this to sunset is what is called the QBI deduction. The QBI deduction allows businesses, and that is self-employed individuals, that is rental properties, S corporations, partnership K1s, were allowed to take a 20% deduction on their net income. And that really helped out a lot because, as we know, a self-employed individual or an LLC partnership, depending on how it's structured, is also subject to self-employment tax of 15.3%. So having the ability to write off 20% of our profit sort of takes the sting out of our self-employment tax. I also felt, and this is just my personal opinion, but I felt allowing to have that additional deduction sort of prompted entrepreneurs to really put the shingle out on their front door and start a business, because there was some tax incentives for them for starting this business to help them kind of take the bite off any beginning business when we're actually spending more than what we're making, or maybe we're in a profitable situation and it can kind of save us some money on taxes. That too is set to expire come January 26th. And that one, I think we might suffer a little bit if it does, because I'm not sure if it's going to promote entrepreneurship because we've lost that. Bonus depreciation, that's kind of a funny thing. It used to be 100%, but that went away in 2023. Then for the 2024 year, or before 2024 was at 80%. That means all my vehicles that anyone bought in the 2023 tax year, I can write off 80% of that. Now it's 60%. And it's going to go down to 40, 20, and eventually 0. There is a law that sort of stalled on the House floor. They want to bring back the 100% bonus depreciation. It was written in that law that it was going to be retroactive back to January 1st, 2023, meaning all the tax returns that are being filed now could have gotten a 100% bonus depreciation. That's why maybe your tax advisor sort of said, let's put you on extension, because if it does pass, we don't have to amend a tax return. Who knows? I believe that might come back up again and be implemented because it was such a positive tax provision. It also sort of prompted, the purpose of it was to prompt businesses to go out and buy larger vehicles, which would hopefully promote more people purchasing American-made vehicles or are going to buy fleets or trucks for their businesses. They were able to write off 100%. That was the purpose of it. It was always set to sort of go down. Obviously, when we're in an inflationary period, you don't want to promote buying. You want to pull buying back, hence higher interest rates and all that kind of fun stuff we're all suffering with right now. So it's tearing its way down and eventually will become 0, which means we revert back to the original tax law. Does that mean we don't get bonus depreciation? Well, we don't get bonus depreciation. We get a fall back on the Section 179, which means we still can write off everything, not vehicles, but equipment and stuff like that. We can write it off in the year of purchase. But I think this law is probably going to come back with the 100% bonus depreciation since it is stalled on the House floor at the moment. So there was some writing of it. The other scary thing that's set to sundown is the tax exemption, right? The estate tax exemption, Right now, the estate tax exemption is something like $11 million. It's $12 million now in 2023. So the problem with this is set to expire also in January 1st, 2026. So what does that mean? It means that anyone who passes away in 2025, they will not get the benefit of such a high tax exemption from their estate. They're estimating this will be cut in half, almost about $6 million. So probably approximately that $5.4 million it was in 2017. So if this doesn't get extended, any family member that passes away in 2025 that has an estate that is greater than the $5.4 million or the $6 million will have to file an estate tax return. Estate taxes are 40%. So they're definitely a sting, and it's really a shame to see that happening. But there are strategies that one can put into place, and that's something that I'd like to address because this one's a scary one with the estate exemption dropping. One of them is gifting. Currently in 2024, you can gift out of your estate $18,000. That means you can gift $18,000 to somebody, your partner can gift $18,000. So approximately $36,000 can leave your estate in a gift. No gift tax return needs to be filed if it's within the $18,000. Now, let's say your son or your daughter comes to you and they're looking for a down payment on a home, and that's a lot more money than $36,000. Let's say it's $50,000. Does that mean you can't gift that? No, you can gift it. It just requires a gift tax return to be filed. Is there tax? No, because it's still within the exemption credit of how much we can gift in a lifetime. But it's a great strategy to get more money out of your estate to your beneficiaries, because this is who you're planning to give the money to anyways, to help lower the value of your taxable estate so it won't be subject to that 40% tax bracket. Another thing is something called an irrevocable life insurance trust. That's called, or abbreviated to, an ILIT. What that pretty much does, it puts the life insurance benefits, the premium. So let's say you had a life insurance policy where your child is going to benefit, they're going to get a death benefit of $500,000. That premium gets to leave the estate. So it's not even accounted in the estate because it's put into a trust. Other thing is charitable donations. It's quite common to have written in there, I know that my living trust has charities that I would like some of my money to be donated to. We all have our causes that we would like to still take care of even after we pass. Well, what a great opportunity now would be to set up maybe a charitable trust, a deferred charitable trust, a charitable revocable unity trust. If you remember Steve Jenkins' podcast, he talked a little bit about that. So that might be something to go back and listen to, but to start getting money out now of your estate, put it into these trusts, start donating it to these charities. One, you get a write-off today if you're able to itemize. And I just said things are sundowning, so that standard deduction is going to be lower, which means itemizing is going to be the wave again. Charity is really going to come into play again because you're going to be able to write off more of that charitable contribution. Think about getting some of that money out of your estate now and into the hands of the charity. Why I like these deferred charitable trusts is I could put a ton of money into the deferred charitable trust. I get a write-off right away on my tax return for that amount. So let's say I got a bonus. Maybe I had some RSUs that hit my paycheck and I sold them. I didn't need the money. Let's say that was about $50,000. I could put that $50,000 into my deferred charitable trust. On my tax return, I write a $50,000 charitable contribution. So I get a write-off of a charitable contribution of $50,000, which means now my itemized deductions are $50,000. I do not have to donate all of that money in that year. I can slowly get it out of my deferred charitable trust year after year after year until it's finally exhausted. But look what I just did as well. I gave myself a write-off of $50,000. I also lowered my taxable estate by $50,000. And that's what's mentioned in my living trust, was to donate $50,000 out of my trust to these certain organizations. I just did it a little bit sooner. The other one is family limited partnerships. This is also a good tax strategy in a sense. So what this really is that you establish a family limited partnership. It's usually, a husband and a wife and the children. As we know, our young children are in a lower tax bracket than we are. And so what we do is we put some of our high appreciable assets in there. Maybe it's our stock portfolio. Maybe it's our rental properties. And so what does that do? It divides the profit amongst the four of us. Obviously, the parents probably own the majority of it, maybe 90%. But then the kids split it 5%, 5%. Depending on their bracket and the income, there really isn't a tax filing requirement for them because the standard deduction wipes that away. So really what we did is we gave 10% of the profit over to our children, and we're only going to pay income tax on the remaining 90%. The key component in that, though, is the fact that we remove 10% of our assets out of our taxable estate. So that's another good thing to do. Finally, it's portability. A lot of people forget this portability, and it wasn't as common in the estate tax return filings in the past because we've had such a generous exemption. I mean, 11 million is definitely a wonderful exemption. And both partners at that time are able to have that $11 million. But, recently, a dear client of mine in California's father passed away. And even though his estate was below the minimum threshold, we still filed an estate tax return. And the reason why was we wanted the husband's remaining exemption, so what was ever left from it, to port over to the wife. So what we did was, let's say after everything was said and done, $7 million of his exemption was left over. That $7 million exemption has now gone towards his wife's estate. So let's say this does sundown. Let's say it is at $5 million, and now the mom passes away. The mom does not have just a $5 million exemption. Because we filed that estate tax return and ported over the remaining of his exemption, mom now has a $12 million estate exemption. What did that do? That helped prevent estate taxes on the remaining assets that mom has in her lifetime. So that's something critical to think about, most particularly if this does sundown. Because, truthfully, it's an election year. We really don't know if they're going to be focused or not on creating new tax law immediately. So there are going to be gaps where this will sundown. So we just want to make sure that we are okay with that. The other thing that you guys have been probably hearing about in the news is tips. Tips. I was at a sushi restaurant today having lunch with a friend of mine. And lo and behold, I'm looking at the television, and sure enough, there's CNN reporting tips. And it's all about President Trump's idea of not making tips taxable. But this really came about with the Internal Revenue Service coming out and saying they kind of want to make a change on tips. They're not making a change on how tips are taxable. They're going to make a change on how tips are going to be reported. So tip income is a taxable income. So the Internal Revenue Service says if you earn money anyway, doesn't matter how you're earning, if it's tips, cash, under the table, technically speaking, you're supposed to pay tax on that. And the way that the tip system works is at the end of the day, the servers are supposed to tally up the amount of money they received in tips. And if it's over $20, now if you only got $20 or below in tips, you don't have to report that. But if it's over $20, you're supposed to keep a tip journal. And you're supposed to notify your employer of how many tips you have received. Because then what's going to happen is they're going to tax you on those tips. You're going to pay Social Security tax on it. You're going to pay Medicare tax on it. You're even going to pay federal income tax withholding, because your tips are now going to get reported into your W-2. President Trump's plan is not to have to report tips, not to make them taxable. That's ridiculous. The IRS is saying, you know what? It's still income. You earned it, so therefore you're going to pay tax on it. But you know what? We kind of don't trust how you're reporting it. So we want to make a change on that. We're going to now allow for tips to be added into either the POS system, which is a cash register system, or it's going to be added into the electronic payment system. When you get to swipe right there, I can't think of what that name is, that type of a system, or Zelle or Venmo or anything else like that. That's how these tips are now going to be reported. It is not going to be based upon the employee's honor roll system. It's actually going to be able to be tracked now through a cash register or any other electronic payment system. So that's really what's going on in the tips world. The final thing I want to talk to you about is what's called basis shifting. And so this seems to be a very big hot topic. So during Biden's tax plan, what he did is he had given the Internal Revenue Service a ton of more money to increase hiring. And in that increase of hiring, they are supposed to increase audits. They're supposed to increase audits on the rich, of how they call it, or on large corporations. Well, the IRS came out and said that they're struggling to find employees. Well, you know what? Welcome to the club. It seems to be the common denominator now. We're all struggling to find employees in today's world. So what they decided to do is they decided to put those resources into something else, and they want to end a very well-used loophole in the tax code. And this is called partnership basis shifting. And really what that means is it means that partnerships transition the basis over and pay little to no tax at all. And so, for example, there's a couple of these transfers that I have listed in the PowerPoint presentation, but what I thought I would do is actually talk about examples. And so one of that is transferring your interest to a related party. So I'm going to use something very common. Let's say you own a home and you sell it to your child. Your home is valued at $500,000, but you decide to sell it to your child for $300,000. What did you do? You potentially created a lower taxable gain to yourself. Because if I bought that property, let's say for $300,000, it's now valued at $500,000. I could sell that property for $500,000 and make a $200,000 profit. I would have to pay income tax on my $200,000, capital gains tax. But I've chosen to sell that property to my daughter for what I paid for it, which is $300,000. So basically what I did was I sold it to them below market, exactly what I bought the property for. I report zero capital gains tax on it. That's something that is considered shifting income to a related party. It could be done in a partnership, for example. So let's say there's a partnership of three of us. Let's say it's myself, my daughter, and a cousin. Okay, we're all related. And I decide to sell my interest in my partnership to my related to individuals. Now, guess what? I'm doing some estate planning, right? Because I don't want my partnership interest to be listed into the estate. So let's say the assets of my partnership are valued at $100,000. I decide to sell my interest in that partnership for $200,000. Yes, I'm going to end up paying capital gains tax on the sale, but what I've done to the partnership, and it's related, is they have the opportunity now to take the value of those assets that are at $100,000, and because I sold my interest at $200,000, they're able to bump up the value of the partnership at $200,000 now, and they've created what is called depreciation. So now they have an asset valued at $200,000 that they're able to depreciate and take a greater write-off for. So that's something that the IRS wants to sort of terminate on this. The other thing is buying into a partnership or contributing into a partnership. So sometimes, we might be a very well-established partnership or we're just starting. So let's say we're just starting. Let's say I own land and my land is valued at $500,000. Well, land is a non-depreciable asset, but I'm going to contribute land at $500,000. That's what I'm contributing. There's no depreciation. There's no write-off. I would have gotten no write-off for the land. And my partner decides to contribute equipment. And the equipment is valued at $100,000. Equipment is a depreciable asset. Right now, you would be thinking, Monika contributed $500,000 non-depreciable asset. Her partner contributed $100,000 depreciable asset. The partnership is only going to be able to depreciate on $100,000. Nope. The law in the code currently says that now the partnership can get that equipment stepped up to the value of what I contributed. So now the equipment is valued at $500,000. Now as a partnership as a whole, we can depreciate $500,000 over 7 years. The other thing is 7 years qualifies for a Section 179, which means we can write off 100% of that equipment in the first year, which means we now got a $500,000 write-off or $250,000 each because we're 50-50. I contributed something I would never get a write-off for. I can't depreciate it. It's land. Now I'm getting $250,000 of a write-off back. That is what the difference is in this basis shifting, is what the IRS wants to table. They believe by just making this change that they will increase collection on tax or increase tax dollars by about 4%. And they feel that is very worth it to close this loophole. The other thing that could potentially be considered part of this loophole is something that I love as a real estate investment strategy, and I talked about that a few podcasts back, and that's the cost segregation rule, where we buy a piece of property, it's valued at X, so I went out, I bought a commercial building, it's valued at $1 million. Technically speaking, that commercial property, I have to depreciate over 39 years, so $1 million, easy math, divided by 39. That's what I get to claim every year for the next 39 years. Cost basis says, nope, I can break it down to its components. The framing of my $1 million property is $300,000, and the remaining $700,000 are windows, doors, sheetrock, you name it, that made up the building. And those have a less of a depreciable life. They're 20 years or below, which means, wow, I can take that Section 179, or better yet, they revert back to bonus depreciation of 100%. I can just take my bonus depreciation of 100%, and I'm writing off $700,000 in depreciation in that first year. I got a $700,000 write-off. That too could fall under this basis shifting. So this is something that I'm going to keep a good eye on to see if this is actually going to be able to pass, or if what the rules are coming on, because this is something they definitely want to do. But we know with the Internal Revenue Service, it takes quite a bit of tries for them to finally get it right. So I think it's going to be a little bit before they finally get it. Hopefully they don't make this retroactive back. I can't believe they will, because this has already happened, and it would be even more chaotic or complicated to start to amend returns. But again, it's something to keep an eye out that this is going to change, and they feel that this is probably one of the biggest loopholes out there. So they're going to kind of put a kibosh on stuff like that. And then lastly, which is not something that really pertains to the majority of individuals, and that's the ERC, the Employee Retention Credit. It just so happened that the Internal Revenue Service, as we all know, during COVID, it was a pandemic thing for businesses, that if they continued to pay employee wages during the shutdown and they were able to prove that they lost business and their revenue went down, that they would be able to get a credit, an earned employee retention credit for all the employees they kept in that payroll tax. So really, it's a portion of that payroll tax that they were able to get back. And the government spent billions on businesses doing that. And of course, there were quite a bit of fraudulent ERC claims that went out there as well. They put a moratorium on it, and the moratorium was really processing, and it was any new ERC claims coming through. They kind of put a kibosh on that. And they were supposed to open it back up in January of processing the ones that they had, and the moratorium was supposed to have been lifted. Well, the IRS announced today that they are going to process about approximately, I think they said something like 20% of the claims that they still had that they're deemed unlikely to be fraud. And so those are going to get processed. So those are back into processing and checks should be pushed out. Then there's this little piece of roughly, I want to say maybe 30 to 80% is going to be needing more research is what they said. And then the 90 to 100%, that last sort of 10%, 20%-ish of ERCs, they're just going to deny because they don't believe that they qualify for it. They are asking the businesses that are still been waiting, and now some of these businesses have been waiting well over a year. Please don't reach out to them, that they are fully aware of this, that processing time is taking a lot longer than promised, but they are getting through to them. So this is just a little bit of information that was just announced today that ERCs are being processed, the ones that they feel have the least likeliness of being fraudulent, but the rest of them, they're still going to be researched and some may be discounted. So if you had ERC claims out there, I would reach out to whoever prepared that for you because they can start pulling transcripts again to see the movement and let you know if you happen to be one of those that a check has been sent out, or you are one of those that maybe the IRS is still processing, or possibly you're one that they just denied it completely, but at least there's some movement going out there on that. And so that's a little bit of information that I have of what are some of the hot topics that have hit the news. I know because we're going to have a presidential debate here a little bit, there's going to be a lot more tax topics that come out. This is usually when my neck of the woods seems to be getting a little bit more exciting. Yes, that's the tax geek in me speaking. So I will definitely keep all of you abreast of the information that I find and try to simplify it as much as possible so that all of you have a better understanding of what is being discussed. I think I might talk about next time tariffs. I'm sure we've all heard about the tariffs. So, but if there is any topic that you guys would like to have discussed, please reach out. I would gladly answer anything. That's really what I'm here for. That's the whole purpose of this podcast, is to give you more information on the tax code, to give you more information on tax strategies, to give you well-rounded information just being a business owner and hearing from other business owners on how they are becoming successful in a variety of different ways. So thanks again for listening. My name is Monika Hengesbach, and it was great to have you. Bye-bye.